Okay, I'm going to go ahead and get started. My name is Mike Verginnis. Welcome. Really excited to be able to talk to you today about a topic that's near and dear to my heart, and I'm assuming yours too, is how to manage your RSUs or your restricted stock units. If you're a tech employee, you get a percentage of your income from stock, and we're going to talk about how to create a personal plan for you. So, just before we get started, a little bit about me. I was a tech executive for many years in Silicon Valley before I became a financial advisor. I've held RSUs, I've held options, I've held ESPP shares. And I'm going to show you something that I created for myself that I think will help you in making your own decisions about your company stock. So let's go ahead and get started. Here's the financial industry disclaimer. I think the thing to take away from this is that this is meant for informational purposes. This is not individual advice. If you're looking for more guidance on how to handle your own situation, you can reach out to me after the webinar and we can talk on a more personalized basis. Okay, let's go to the next slide. So our quick agenda here is first, why do you need an RSU management plan? We're going to talk about that and give you some context. And then we'll start with the 3 questions you need to ask yourself about your RSUs. These are things that put you in the right frame of mind to thinking through it. Then we're going to show you step by step how to create a personalized plan for your RSUs. I've nicknamed this the S.T.A.R.T methodology, and it's 5 different aspects to it. And then we're going to do a summary, and then we'll take Q&A. If you have any questions, burning questions you'd like to ask during the webinar, please put them in the chat. Otherwise, we can take care of them at the end. All right, next slide. So we're going to do our first polling question. And the question we're going to ask is, the primary reason I don't have a plan to manage my company shares, I'm assuming if you're here, you don't have a plan, is A, my concentration in my company stock is too low. B, I don't know the tax implications of selling versus holding. C, holding has worked for me so far, so why change? D, I'm not sure how to create a plan, so I haven't. Or E, maybe you do have a plan and you're just looking to confirm what you've decided thus far. I am. Why don't we do this? Why don't you drop in the chat your answers and we'll take a look and see what people are saying. What my experience is that people don't know how to create a plan. How would you go about it? But let's see what other people have to say. Right? Let's see, what do we have in the chat here? C and D is what I'm hearing. Yeah, I think that's very common. Those are the 2 most common answers. Hey, I don't know how to create a plan, so we'll cover that here. The other thing is C, holding has worked for me so far. That is very common. And we'll talk about why that makes it challenging to put a plan together because people think of volatility in one way, which is things are going well. Why would I want to change? Okay, let's go to the next slide. So why have an RSU plan? We're going to talk about 3 companies that we all know very well, quality companies where something happened and the stock dropped significantly. This is an example of what you're looking at is a chart of Amazon during the tech bust. The company was doing fantastically well. It was valued at this point, think about it, it was over $5 a share. And then the tech bubble burst and the stock dropped in a period of a year and a half down to 84% of what it was before. So the key takeaway here is, hey, volatility, most of us have benefited from positive volatility in our stock. That's why we're talking about how to manage this. But there is negative volatility. And if you're on this call, chances are good that your stock is pretty richly valued right now. The market is high. And so the question is, will it stay at that level, or can something happen that has nothing to do with the company's performance that affects the stock? Okay, let's go to the next slide. This is one that's more recent. You probably remember this. This is Facebook, now Meta. What happens? Sometimes great companies take strategic missteps. We all remember when Facebook became Meta and it became all about the metaverse. Well, the stock market didn't like that very much. And you can see from 2021 down through 2023, the stock dropped 70%. So the stock went from almost $380 a share down to under 100. What's interesting about this is over the next 3 years, where we are now, the stock is up from 100 to over $650 a share. But if you had sold at the high or toward the high or diversified somewhat, and then were able to buy in at $100 a share, that would have been a huge benefit to you. Okay, let's take a look at the last example. Now, this one's one of my favorites because this is a company I used to work for. This is PayPal. So, as you can see, PayPal stock was up over $300 a share in 2021, and it dropped rapidly in a period of about 6 months down to 100, and it hasn't broken 100 in over 3 years since then. Did something disastrous happen to PayPal? No. PayPal grew its revenue during that entire period. What happened was its growth slowed a little bit from what expectations were, and its profitability went down. It had some margin pressure, and that was all it took to take a highly valued stock from over $300 a share down to under 100. Okay. This is why we need a plan, because stocks don't always act the way you hope they will. So the three questions we want to ask, take a look at these two asset lists. They are virtually the same, except for in asset list one, you've got cash of 500,000, which is 40% of the total. And the asset list number two shows just vested stock of the same amount of 500,000 or 40%. So the question I want to ask you, which really helps frame how you feel about your company stock, is if you had list one, you had cash instead of list two, where you have just vested company stock, would you use the cash to buy your company stock? Think about that question for a minute. Okay. So when considering that, look at question two. So, okay, you have 500,000. How much would you buy? Would you buy the full 500,000 or would you buy something less? And then maybe the most important question here is why? Why would you do what you think you should do? What you're thinking you should do? Would you buy? Would you buy some or all? Would you put it into something else? The reason is from a tax perspective, asset list number one and asset list number two are exactly the same. When your company shares RSUs vest, you owe income tax on those. And it's just as if you had just bought them. So if you turn around and sell them at that point, you would have no additional tax. You wouldn't be incurring any additional tax. So you can turn it into cash immediately and diversify it. But a lot of people don't do that. They don't understand the tax implications. So to hold your RSUs, choosing to do that is the same as choosing to buy them at that moment. Maybe you want to buy them all, maybe you don't. Okay, remember, taxes due at vesting, capital gains and loss going forward from that are based on the vesting price as if you had just sold it. So there's really no inherent benefit tax-wise from holding vested RSUs. This is a mistake a lot of people make, especially with those who've had stock options in the past. All right, let's go to the next slide. So why don't we put these answers as well into the chat? Okay, here's our second polling question. Roughly what percentage of your invested assets? So think about your IRAs, all of your brokerage assets, your 401ks, everything where you're invested in stocks or bonds. How much do you hold in your company stock? A, under 20%, B, between 20 and 40, 40 and 60 for C, or over 60%. Okay. So let's take a minute. If you want to drop your answers into the chat. Okay, so actually we're seeing this is unusual. What we're seeing, and which is great actually, people are responding that they have under 20%. Often what I see is that when people address their stock options or that holding, they realize, oh my gosh, I've got over 50% of my wealth in this stock. That's when you really need to make sure you have a plan. But even if you're around 20%, that's considered a concentrated position. So let's talk a little bit about that. Let's go to the next slide. So this is the methodology I put together to get people to think through and create a plan that's personal for them. So I call it the START methodology because we all want people to start this process as soon as possible, regardless of whether they sell their stock or not. So S is about self-awareness. I think the number one thing here is, and I like this graphic a lot, is people think of volatility is a positive thing. Stocks always go up. But this graphic shows you that wherever you are, volatility could mean going up or down. What is the amount of volatility you can experience in your portfolio and be psychologically comfortable? What I mean by comfortable means is you don't panic. You don't consider, oh, I need to change things or I need to act right now because I'm uncomfortable with how my stock or my portfolio is moving. So ask yourself that question. And there are tools which I can refer you to help you to get a better feel for that. And then the other question is how much company stock is too much for you? A concentrated stock position, as defined technically, is anything over 5% of your portfolio. Why is that? Because it takes about 20 positions in equities to really take the individual company risk out, where you're only exposed to the market. And that's why people say 20 into 100%, 5% is the maximum. Uh, but people in Silicon Valley especially don't think that way, and they've had benefit from taking on more risk. But the important thing is when you're determining how much is too much, you need to think about the context, right? Your age, the obligations you have, how long you're going to be investing and working, what your growth goals are, and then the risk tolerance that we talked about. So it's very much an art rather than a science to figure that out. But I do want to call out three mistakes that I see people make over and over again. The first one is knowing your company, but not your stock. People think if they understand their company and they understand the way the company, how well the company is doing, that they're going to know which way the stock is going to move. And the examples I had earlier will show you that that isn't necessarily the case. So keep that in mind. Underestimating downside volatility, we talked about that. We all know the upside, it's a wonderful thing. Downside can be quite painful. And then complacency, just, hey, that sounds complicated. I'm just going to leave it the way I have it. And people do nothing. That almost invariably leads to leaving chips on the table because people ultimately act if the stock moves against them. Okay, let's go to the next slide. So the T in START is what's your total portfolio? What else do you own? That's really is going to determine what you do with your portfolio. So what I've done here is I put three different examples from pie charts from the highest risk all the way up to the lowest risk. So remember, diversification is a factor of not only your company stock concentration, how much of it does it represent your portfolio, and then your other assets, how are they invested or what do they represent? So if you look at the slide here, if you go left to right, the blue section is a concentrated stock position. I used Google here. It could be any company. So obviously, the more you have in your company stock, the higher the risk. So as you move across here, you see the company stock percentage go from 80 to 50 to 20. But then the other part of it is what else do you have invested? Sometimes people think, oh, if I have money in five other tech stocks, I'm really diversified. Well, you're more diversified than you would be if you had it all in one stock, but most people would say that's not diversified. And then how do you go from five tech stocks to a globally diversified portfolio or a US diversified portfolio? That's that's what we need to do, what we need to look at to determine how how risky is my stock position. Okay, let's go to the next slide. So the A and the R in your methodology, what's needed now and in the future. So the A stands for these are things that you know you're anticipating you're going to spend money on. What I've seen people do is hold their stock and almost become captive to their stock, meaning it starts dictating whether they do things or not, whether they postpone certain purchases or certain events in their life. I really encourage people not to do that. So sit down and say, okay, what do I have maybe I want to buy a house, maybe I want to remodel, weddings, college, all of these things, these anticipated expenses, map them out over the next few years and understand where you might need money in addition to your salary to be able to fund fund your life. And often selling some of your shares makes sense in doing that. And then the other part R is why are you investing? And this is key because I would say not only are your goals and your timelines important, your investment horizon is important too, right? The closer we get to retirement age or where we're going to start taking less risk, the more we should be looking at diversifying our company stock position, even if it's done very well for us. Okay. And then we'll go to the last slide. So far we've talked a lot about the art of making this decision. Here I want to talk a little bit about the the science. So the T stands for testing with scenarios. I think it's important for people when they're thinking about selling their stock or holding their stock to understand what the universe of possible outcomes are. And we can do this statistically, and we can do it pretty easily with a basic tool. So if you know anybody who is a whiz at Excel, they could probably create what's called a Monte Carlo simulation for you. What this is it basically takes the statistical out profile of your company stock or the market as a whole and says, we're going to run thousands of scenarios here and figure out what's the probability of different scenarios over time. And that's what this graph shows you here. So if you look to the right, it's taking thousands of outcomes and it's saying, okay, the dark blue, these are the most likely outcomes in the range. And then there are outliers, of course, over time, but they're much less likely. Okay, so how do we do that for you? Well, I built a model myself that I'm happy to share that shows, hey, the return on your company stock is a variable. The return on a diversified portfolio is. And then the question is, how would you time those sales and move from a concentrated position to a diversified position? What are the possibilities, right? So what I tell clients all the time about this is people like to do forecasts. Forecasts, the old joke about forecasts is they're always wrong. The question is by how much. But when you run a Monte Carlo simulation, you're looking at probabilities, right? Probabilities are always correct, and forecasts are usually wrong. The question is to what degree. So I think it's really important for people to understand what could happen and then make decisions on those probabilities. Now, there are two things here that I think are going through this process are really, really helpful. One is it gives you perspective. This is the bullet at the bottom here. What I think is important is not only to show these Monte Carlos, but to show what can happen with your money over time. I call it the seeing is believing. The power of compounding is often people realize, hey, I don't have to take the amount of risk that I think I do to grow my portfolio to a point where it supports me well, right? It leads people to take less risk, which means there's going to be more certainty in your outcome. And the other thing I see happen a lot is people often think about these things in the binary, right? I either need to sell or I need to hold. What I think most people determine when we do this is that some point in between is more likely. Don't be binary. It's going to be, hey, I'm going to hold my some of my stock because I want that potential upside, but I'm not going to let it ride and bet against the volatility that could really uh, decrease the size of my portfolio. So almost always that's the decision that people come to, somewhere in between. Okay, let's look at the last slide. So here, just want to emphasize customizing a company stock management plan is really the best way to optimize your returns for you because it's personalized. It takes into account what you want to do with your money and making sure your money's working for you and what you should be doing to optimize for that and your retirement. Really, it's important to understand your RSUs, your restricted stock units, your taxes, and know yourself. Knowing the facts and knowing you and your risk tolerance and how you want to approach things is important. The START methodology, it's part art, it's part science. It's the best way, I believe, to take a holistic approach to this and not allow your decisions about your stock to be emotional or inconsistent with what you're really trying to do long term. And again, I think it's important that all these plans, you hear a lot about how important a customized plan is for investing. I think it's even more important to have a customized plan for managing these positions. It is part art and it is part science, and there are ways to go through it that will give you confidence in how you move forward. The last thing I want to say is a personalized plan. Once you have a personalized plan for how you want to manage your stock, your company stock, what it does is it really then reveals what kinds of tools and strategies work best to do that. I would encourage you to work with somebody who understands the tax issues involved in exercising stock, in diversifying stock, taking capital gains. The correct tools and strategies, there are so many of them. If you have a plan that you believe in and you know is personalized for you, the how becomes relatively easy. And that's why when I work with clients, we do the plan first and then we do the implementation later. Okay. So on the last slide, I just wanted to open it up for Q&A. If anybody wants to put anything into the chat, here's my contact information. There will be a recording of this that we'll post to my YouTube channel later today or tomorrow. Uh, and the deck as well is available. Any questions? We covered a lot of ground. Any questions about the art or the science part of this? Okay, let's see. We've got a detailed one here. Example. If your income is 250,000, you sell 100,000 vested RSUs. I'm assuming that's dollars. Does this increase your tax bracket, including paying any capital gains? So, the answer is it is not listed as capital gains. It is income. So when your shares vest, remember it's when they vest, not when you sell them. So if they have vested and then you hold them and you sell them, depending on how long you've held them and sell them, the difference between the price they vested and the price you sell would be capital gain, right? But when it vests, when the shares vest, it automatically increases your ordinary income or your taxable income, which could push you into a higher tax bracket. So if you are selling, if it is a capital gain and not an income tax issue, then it's always better to sell at in the next year for two reasons rather than in the current year, especially this late in the year. Um, the The reason is you won't owe the capital gains tax on anything you sell in January of 2026, next month. You wouldn't owe that money until April of 2027. The other benefit to doing that is it gives you a full year to work down your capital gains tax liability by investing in ways that generate paper losses for you so that you don't owe as much money in April of next year. And that's a technique I'm happy to discuss with people. It's called direct indexing, and it's something that I use with a number of my clients. So I have another question about taxes. I think I covered that one in the answer previously. Um, if you, again, I think that it's important as far as knowing when to sell. When you sell is going to create either a capital gain or loss. Remember, if it's RSUs and they're vesting, you're already going to owe money for the value of the stock that vested for 2026. Um, and so if you don't if you don't have time to reinvest it in 2025, I have a question here. That's all right. The most important thing to do is understand whether you're, again, if it's vesting, you've already owed the tax. If you've held them after the vesting, the gain or loss will be short-term or long-term. Happy to go into that in more detail one-on-one with somebody. And then there's one more question, and time's up, but I will stay on for whatever, as long as people want to ask questions. Let's see, when calculating portfolio concentration, would you include non-liquid assets like real estate or 401k in the denominator? Great question. What I do both. I do both. And if you're talking about non-liquid assets, you're looking at the equity in your home, right? So, for example, if your home is, it's basically the market value of your home minus what you owe on the mortgage. I tend to focus on the investable assets because I always assume that the house is not, I don't think of your personal house as an investment. I think of it as where you live. It doesn't generate income for you. But you can look at it both ways. If you had a lot of equity in non-liquid investments, I would say it would give you reason to be a little more aggressive if you wanted to be on how much concentration you had in your company stock. I hope that answers answers your question. Any any other questions? Okay. Great. Well, thank you so much for joining. I hope you learned something. I hope it was helpful for you in how you think about your own company stock. And have a great rest of the day. Take care.